Some wild swings in the stock market over the last week have a lot of Americans doing a double take at their portfolios. A lot of questions about what's going on and what does this mean for the average investor. For some insight into this current financial climate, we want to go now to Brett Angel. He is a senior wealth advisor with Marks Group Wealth Management. Brett, thank you for being here. Let's get started with the scene setter. So a lot of people look at this overall economy, they see positive growth. So what's going on here?
Yeah, well, the stock market is finally starting to take inflation seriously. You talk about the positive things going on in the economy. Those are all true. If you look at unemployment, it's recovering around 4%. That's near 17-year lows. The housing market continues to be strong. Anyone who's tried to put an offer in on a home in the Twin Cities recently knows it's been competitive. If you look at corporate earnings, they continue to outperform consensus expectations pretty consistently. So that's all good. I think where we go from there is now there is starting to be some concern that the economy may be too strong for its own good. And when you get that threat of inflation, that's what has triggered some of the recent movements. Specifically, when you talk about news that has happened, specific data points, there was the latest release from the U.S. Labor Department earlier this month that did show wage inflation was the highest it's been over the last 12 months since 2009. So that's certainly one thing that's contributing to what's happened in the last 10 days.
Okay. So can you pull out your crystal ball for us real quick? Look into it. Now, do we expect this volatility to continue on?
Well, it's an interesting question because we've basically gone from no volatility over the last 2 years to extreme volatility in the last 10 days. So we don't know for certain, nobody does, whether this current correction is going to get worse before it gets better, or if yesterday, for example, was as bad as it'll get and we'll resume this upward trajectory. What I would say, and what we're telling clients, is that this period of the last 2 years where there's been exceptionally low volatility, that's probably over. I mean, we've been saying that felt like it was an escalator. If you were an investor and you had money in U.S. equities, you basically had to do nothing. You could just stand there and get where you wanted to go, which was double-digit returns on an annual basis without any bumps in the ride at all. So I would not expect that to continue. Or to resume that, I should say, once this correction is over.
Okay, and you were mentioning your clients. Most of your clients are individuals, they're families. What else are you telling them specifically? These are folks with things like IRAs. They're watching this market and maybe getting anxious.
Yeah, well, the first thing is to remind them that corrections are normal. And what we've seen over the last 2 years is the opposite. That's actually been the exception to the rule. If you go back to 1980, that gives us about 37 years worth of calendar year performance and data for the S&P 500. In 21 of those years, there's actually been a pullback at some point in the year of at least 10% or more. And yet, over that same period of time, the returns for investors in U.S. equities have been exceptionally positive. So number one, corrections are relatively normal. Number two, it will not stop equity markets long term from giving very, very good and positive returns. All
right. Brett Angel, Senior Wealth Advisor with Marks Group Wealth Management. We want to thank you for your time and for being here and giving us some insight into this this kind of situation we're not used to, at least not for a while. Thank you so much.
All right. Thanks, Amy.